TSS and BTE have joined forces.
Context.
Power.
Edge.
The new paradigm of trading.
Imagine you're like an insurance underwriter. Right?
Yeah.
You look out the window, you see this perfectly clear blue sky, just not a cloud in sight.
Yeah.
So you start selling hurricane insurance at a massive, unprecedented discount. I mean, practically giving it away.
Right, yeah.
And then, 3 hours later, a Category 5 storm makes landfall right on top of your office.
Which is just a catastrophic failure of risk modeling.
Exactly. That level of absolute mispricing, where the people who are literally supposed to calculate risk get caught completely flat-footed, is exactly what happened to the biggest players in the options market in early August of 2026.
It really was. You have these, incredibly sophisticated market makers, and they're heavily reliant on automated hedging algorithms, right? So they looked at the landscape, assumed absolute quiet, and they were subsequently run over by one of the most violent upside moves we've seen in recent memory.
Yeah, run over is a good way to put it. Well, welcome to today's deep dive. I'm really excited for this one. Our mission today for you listening is to unpack a highly sensitive stack of financial notes from SpotGamma. And these cover a very specific, very chaotic 3-day window, August 3rd through August 5th, 2026.
Yeah, an absolutely wild 3 days.
Right. During this period, we saw this explosive, what they called an upside sneak attack, which basically pushed the S&P 500, the SPX, to fresh all-time highs. So we have all the raw daily options data, the macroeconomic triggers, and the single stock flows.
And what's so valuable about this specific stack of notes is that it doesn't just show us that the market went up. It actually gives us the exact structural mechanics of how it went up.
Yes.
We basically get to look under the hood and trace the capital flows minute by minute.
Okay, let's unpack this because I want to start with the spark that ignited this whole thing. So Monday morning, August 3rd, we get a macro trigger hitting the tape. It's a rumor. The notes mentioned Donald Trump actually signaled this about Iran negotiations starting that afternoon.
Right.
Now, regardless of the ultimate truth of the rumor, what actually happens mechanically on the trading floor when a headline like that hits?
So the immediate reaction happens in the energy markets. I mean, oil traders don't sit around waiting for diplomatic confirmation, right? They trade the headline.
Shoot first, ask questions later.
Exactly. So crude oil, ticker CL, immediately plummeted 6%. It dropped straight down to $79 a barrel. And, in the complex machinery of modern markets, a sudden drop in oil is never just about oil. It creates this instantaneous cascading effect across, pretty much every other asset class.
Because it immediately changes the calculus on inflation, right?
Precisely. Heading into that Monday, we were seeing U.S. 30 yields hovering near 20-year highs. The bond market was incredibly tense about persistent inflation. But the moment crude oil drops 6%, those inflation fears ease up, even if it's just a temporary thing.
Right, they take a breath.
Yeah. When oil goes down, yields come in slightly.
Yeah.
And when the pressure of high yields is lifted off the equity market, it injects massive upside fuel right into stock futures.
It's like throwing a rock into a pond and watching those ripples turn into tidal waves. And we saw the result of that fuel instantly. I mean, by Monday afternoon, the S&P 500 had gained 1.5%, closing at 7,601. You had the Mag 7 tech stocks heavily outperforming. Amazon officially crossed the $3 trillion market cap line.
Oh, yeah. Massive moves.
But here's the part I'm really struggling to wrap my head around. The SpotGamma notes explicitly mention that Iran eventually denied the negotiation rumor.
Yep. They denied it.
So if this was just an unconfirmed rumor and the entire premise of the rally was based on it, why didn't the market immediately give back those gains once it was denied? Like, why did it react so violently and just keep squeezing higher?
To understand that, we really have to look at the structural setup of the options market before that headline ever hit the tape. So heading into that week, SpotGamma had identified this crucial level they call the SPX risk pivot.
Okay.
And that pivot was sitting at 7,480. Because the index was trading above that 7,480 mark, the market was surrounded by what we call positive gamma.
Right, and I know we hear the term gamma thrown around a lot, but walk us through the actual mechanics of that. If I'm a dealer sitting at a desk, what does positive gamma actually force me to do?
Right, so if you are an options dealer in a positive gamma environment, your automated hedging actually acts as a shock absorber for the market. To keep your books perfectly neutral, the math literally dictates that you have to sell when the market rallies and buy when the market dips.
So you're constantly fading the move.
Exactly. You're constantly providing liquidity against the trend, which naturally suppresses volatility and, keeps the market in a fairly tight, stable range.
So it's kind of like having a governor on a golf cart or an engine. It prevents it from revving too high or dropping too low.
That's a great way to put it. And on top of that, implied volatility was slowly contracting across the board.
Yeah.
And when implied volatility drops, it triggers this thing called a vanna-based tailwind.
Vanna-based tailwind.
Yeah, mechanically, as options lose their volatility premium, dealers have to adjust their hedges by slowly buying the underlying index. So going into Monday, the whole structure was primed for a very slow, very boring, stable upward drift.
Right.
But the violent jump caused by that oil drop, it pushed the index up so fast that it started tripping all these hidden wires in the options market.
Which brings us to the morning of Tuesday, August 4th. And really, back to that hurricane insurance metaphor we started with.
Yeah.
Because this is where the options market gets caught completely flat-footed.
Oh, the mispricing here is staggering. I mean, on Tuesday morning, despite Monday's massive 1.5% blowout move, the options market was heavily underestimating risk for the day ahead.
Yeah.
The data shows the 0 DTE, the 0 days to expiration straddle for the SPX, was priced at just $25.50.
Wait, let me stop you there, because $25 on the SPX feels incredibly low. Just put that in perspective for me. When they price a 0 DTE straddle at $25.50, how much movement are they actually expecting the market to make that day?
They were pricing in an expected daily range of just 33 basis points.
Oh, wow.
Yeah, 1/3 of 1%. They expected absolute dead quiet.
It's like pricing that hurricane insurance at a massive discount right as the Category 5 storm hits. Because the S&P 500 actually delivered a 180 basis point move that day, right? They were off by an absolute mile.
They got totally caught out.
So take me down to the trading desk. What physically happens to those market makers who sold all those cheap options when the market suddenly surges 180 basis points instead of 33? Like, what do they do?
It triggers what the notes basically describe as a fear-based oh no response.
I can imagine.
Right. Think about the dealers who sold massive amounts of 0 DTE call options in the 7,570 area, assuming the market just wouldn't move. Suddenly, the market is ripping higher, blowing right past their strikes. They're instantly bleeding capital.
Just hemorrhaging money.
Exactly.
Yep.
And to stop the bleeding, they are forced to cover their short calls and, roll their exposure higher. So they rolled from 7,570 up to 7,590 and then again to 7,610.
And mechanically, to cover a short call, you physically have to buy the underlying index, right?
Yes, that is the critical mechanism. Their sheer panic to cover their own risk forces them to buy the S&P 500 in massive quantities. This forced dealer buying artificially accelerates the upside.
Which just pours gasoline on the fire.
It really does. And it gets much more combustible because by Tuesday afternoon, all that forced buying pushed the S&P 500 right through the 7P 500 level. And according to SpotGamma's heat map, breaking 7,700 pushed the dealers out of that stabilizing positive gamma we talked about earlier.
Right, the shock absorber.
Gone. It pushed them straight into a pocket of negative dealer gamma.
And negative gamma basically flips that entire hedging script upside down, doesn't it?
Entirely. Remember how positive gamma forces dealers to sell the rips and buy the dips?
Yeah.
Negative gamma does the exact opposite. To keep their books neutral in a negative gamma regime, dealers are forced to buy when the market is going up and sell when it's going down. Yeah, their hedging math literally demands that they chase the trend. So once they crossed 7,700, their automated buying poured pure accelerant on the rally, pushing it to fresh all-time highs.
Okay, and this triggers a dynamic in the notes that I found super fascinating. They highlight a spot up, vol up scenario. Now, normally, those two things are inversely correlated, right?
Usually, yes.
Like when the market goes up, people relax, they feel rich, so volatility drops. But here, the market is skyrocketing, and fixed strike volatility is actually rising across the board. Why is fear going up while the market is making everyone rich?
Because in this specific case, it wasn't fear, it was aggressive speculation.
Oh, okay.
Traders weren't just buying stocks, they were buying upside call options at such a furious, relentless pace that they literally bid up the price of volatility itself. They were stuffing the system with so much demand for upside exposure ahead of all these major tech earnings that the market makers had no choice but to massively hike the premiums.
And the sheer volume data here is just wild. Like, the SpotGamma notes track this metric called HIO, which measures cumulative customer delta. Mechanically, that is showing us the net flow of aggressive directional options trading hitting the tape.
Right.
On Monday, HIO registered positive $14 billion, which was the biggest reading in 30 days. And then on Tuesday, it hit a staggering positive $16 billion. The NASDAQ alone saw $8.5 billion in positive delta notional.
It's just a literal tidal wave of capital. But here is where we kind of have to shift our focus, because an index is, well, it's just a math equation made up of hundreds of individual stocks.
Right.
And with that much capital flowing in, we need to look at exactly where it was landing.
Yeah, because when you look at the S&P 500 on a chart, it just looks like one big uniform green arrow going up. But underneath the surface, this wasn't really a coordinated rally. The index was fracturing.
Totally. The notes highlight this metric called Q1M, which basically measures the 1-month implied correlation among the stocks in the index. That correlation metric slammed back down to under 8, which is what they call the we want to hedge level.
Let's use an analogy here for our listeners. If the S&P 500 is like a highly synchronized flock of birds flying in a perfect V formation, a high correlation means they all turn left or turn right together, right?
Exactly.
But when correlation drops under 8, it's like the flock entirely breaks formation. They scatter. Every bird is just darting off in a different direction, chasing its own food.
That is a perfect way to visualize dispersion. And the mechanism driving that dispersion is tied directly to the volatility we just talked about. Because index-level volatility had essentially tanked prior to this event, trading the S&P 500 as a single block was, frankly, boring.
Right, no edge there.
Exactly. So traders took all that $16 billion of aggressive options flow and started hunting for single stock volatility. They piled into highly concentrated thematic bets. The notes even feature a compass chart showing top stocks spread wildly all over the map.
So let's talk about those specific themes they were chasing, starting with the massive winners. The semiconductor sector, tracked by the SOXX ETF, staged a massive 7% rally. That's its largest 4-day rally since 2020.
And the specific options mechanics underneath that semiconductor rally were just incredible. Look at SanDisk, ticker SNDK. Traders were anticipating their earnings report, and they bought 850 lots of weekly calls.
Okay.
But the implied volatility on those calls was sitting at 230%.
Wait, if the implied volatility is at 230%, doesn't that mean those options are priced at an absolutely astronomical premium? Like the market makers know a massive move is coming, so they make it incredibly expensive just to place the bet. How do you even make money buying options that are that expensive?
It's incredibly hard. The underlying stock has to deliver an absolute blowout move just to outpace the premium you already paid. And in SanDisk's case, it actually did.
Right.
The stock gained 6% on the day, which was violent enough that even those wildly expensive calls jumped 8% in value. We saw the exact same mechanism in DRAM. Someone swept up 50,000 lots of the 60-strike calls. The stock rose 7%, and those specific calls skyrocketed 40% in a single session.
That's incredible. And we also saw huge flows rotating into the software side of the AI trade. So Palantir ticker PLTR, they released their Q2 results and fundamentally just blew past the estimates. They reported a 150% year-over-year surge in their U.S. commercial revenue.
Massive numbers.
Yeah. The stock jumped 13% initially and eventually surged 30%.
Yeah.
It was kind of the ultimate proof of concept that traders were desperate for showing that the whole AI narrative can actually generate real commercial cash flow.
But, we really have to look at the other side of that coin, too. Because while traders were willing to richly reward Palantir, they were completely ruthless with companies that couldn't justify their valuations.
Here's where it gets really interesting, because in a euphoric, liquidity-driven melt-up like this, you'd kind of assume a rising tide lifts all tech boats.
Right.
But that wasn't the case here. Even in this rally, AI clearly has incredibly strict taskmasters right now.
AMD is the absolute prime example of this reality check. They reported earnings during this exact same window, and they actually dropped 7%.
On an up day for the market.
Exactly. And why? Because their forward sales guidance was slightly weaker than expected. The market is pivoting, right? 6 months ago, investors were just blindly buying the infrastructure dream of AI. Today, they are demanding immediate hard returns on those massive data center expenditures.
Show me the money.
Yep. If you don't show the revenue, the options market will aggressively sell you off, even while the broader index is making fresh all-time highs.
And then we have SpaceX, ticker SPCX, which offers a totally different lesson. This is a masterclass in how options market mechanics can literally ruin a fundamentally strong earnings report.
Oh, this one is fascinating.
Yeah, the notes show that SpaceX beat revenue estimates. They narrowed their operating losses. On paper, it's a solid bullish report. Yet the stock dropped 5% in after-hours trading. What happened there?
It comes down to something called skew premium. Heading into that earnings report, retail and institutional traders were so incredibly bullish on SpaceX that they relentlessly bought upside calls. As we discussed earlier, all that buying naturally bids up the price of the options. They pumped the implied move to a massive 14%.
So the options market had mathematically priced in a 14% rally just as the baseline expectation. Anything less was a failure.
Exactly. And this creates a brutal hurdle for the stock, a concept the notes call earning upside into rich vol colors. When call options are that rich, a company can't just beat estimates, they have to absolutely obliterate them.
Right, because of the volatility crush.
Yes. Because when the earnings are released, the uncertainty is gone, and the implied volatility immediately crushes back down. If the stock only moves 4% or 5% on good news, the value of those expensive call options completely collapses due to that crush. The options traders get wiped out, which triggers selling pressure on the underlying stock.
So the bar was just set entirely too high by the structural mechanics of the options chain itself.
Exactly.
Which brings us to the most critical disconnect in these August 3rd notes. Because while equity traders were throwing this highly dispersed, incredibly leveraged party in the tech sector, bidding up options and pushing the S&P to record highs, a totally different, entirely contradictory story was playing out in the bond market.
It is, without a doubt, the single most glaring anomaly in the data. We have to look at the options positioning on the TLT, which is the ETF tracking long-term U.S. Treasury bonds. The put skew on the TLT was sitting in the 98th percentile.
Wow.
Meanwhile, the call skew was down in the 2nd percentile.
Let's clearly define what those percentiles mean in real terms for the listener. That is historically extreme positioning.
Very extreme.
It means the demand for options betting that bond prices will fall, which mathematically means yields will rise, was at the 98th percentile of historical data. I mean, it's almost maxed out.
And the demand for upside calls on bonds was practically non-existent. Basically, no one was betting on lower yields. The options market was utterly convinced that interest rates were heading higher.
And at the exact same moment, if you pull up the QQQ, the NASDAQ ETF equity traders were smashing their put skew down to the 14th percentile.
Right.
Nobody in the tech sector was buying downside protection.
So what does this all mean for you as a listener? Because the bond market is notoriously referred to as the smart money in the room.
Right.
They sniff out macro risks long before equity traders do. If the bond market is screaming at the 98th percentile that yields are going up, which is the exact macro force that traditionally chokes off stock rallies and tech valuations, why on earth were equity traders completely ignoring them? Were they just blind to the bond data? If we connect this to the bigger picture, they weren't blind, they were just utterly complacent. The note suggests that equity traders were treating the S&P 500 as an equity risk-free environment.
A risk-free environment for equities. That sounds dangerous.
It is. But because we've had so many dips bought immediately in the past year, traders felt the downside risk had already been bled out of the system. They were milking the volatility premium out of the tech trade, assuming the central banks would ultimately save them, regardless of what the bond yields did.
But that bond positioning is like a blaring red warning light on the dashboard. It implies that this massive S&P 500 rally we just analyzed isn't built on a solid economic foundation. It's an ultra-leveraged, heavily overstretched mechanical squeeze.
It is a structure where the internal pressures are completely misaligned. I mean, you have equity euphoria built on top of negative gamma mechanics, operating in direct defiance of the underlying cost of capital.
Which really brings this entire three-day window into sharp focus. Let's recap this wild ride. We started with a geopolitical rumor about Iran, which acted as the spark by moving oil.
Right. But the true explosive fuel was a heavily complacent options market. Dealers priced in a tiny 33 basis point move, got hit with a 180 basis point storm, and their panic to hedge their short calls forced the market violently higher, right into 700-800 resistance.
And that forced buying broke the index apart, sending correlation plummeting and creating massive dispersion. Traders hunted for yield in single stocks, rewarding Palantir, punishing AMD's lack of immediate ROI, and getting completely crushed by the skew premium in SpaceX, all while actively ignoring a bond market that is positioning heavily for higher rates. I mean, it is a wildly fragile ecosystem.
It really is a market that currently requires absolute perfection to stay standing.
And that leaves us with a final, very provocative thought to mull over based on these notes. We just spent this deep dive looking at the utter chaos that erupted when the options market mispriced a single day of movement to the upside. But SpotGamma points out that we have a massive macroeconomic data point looming right on the horizon, the August 12th CPI inflation report. If at the money, volatility is still scanning as cheap, and the equity market remains this overstretched, this disconnected from bonds, and highly reliant on uncorrelated negative gamma mechanics, what happens to this highly combustible house of cards if the upcoming inflation data surprises everyone in the opposite direction?
Whoa, that is the multi-billion-dollar question. Because when you are in a negative gamma environment, the hedging algorithms don't just amplify the upside. If the trend reverses, they're forced to aggressively sell into the weakness.
So the trapdoor can open incredibly fast.
Very fast. It's definitely something to watch.
Absolutely. Well, it's something to keep a very close eye on as you watch the tape this week. Thank you for joining us on this deep dive. Keep questioning the data, keep looking under the hood, and we'll catch you next time.